Welcome, ladies and gentlemen, to the Uranium special on Commodity TV. Yes, I know, it's time to talk about uranium because this is the next huge market aside of silver, and uranium will be in the future one of the key energy suppliers through nuclear energy. Uranium was always an energy metal in controversial demand and heavily discussed in society. In Germany, politicians thought they do not need any longer nuclear power, which was a complete false thinking, and now is the country at risk to lose its economic power and stability due to the highest power prices in the world. Nuclear power is, again, very important to supply the industrial production, households, and also to charge the e-mobility and especially the future planned wave, or shall I say tsunami, of e-mobility. Renewable energy is nice and good, but baseload power is required for developed countries. A new demand source of power is AI and the needed data centers worldwide. Nuclear energy is not only in a renaissance, it is needed if we want to make this planet a bit greener, to be honest. The production from world uranium mines has in recent years supplied 90% of the requirements of power utilities. The primary production from mines is supplemented by secondary supplies, formerly most from ex-military material, but now the products of recycling and stockpiles built up in times of reduced demand. All mineral commodity markets tend to be cyclical, what means prices rise and fall substantially over the years. But these fluctuations tend to be superimposed on a long-term trend decline in real prices as technological progress reduces production costs at mines. In the uranium market, however, high prices in the late 1970s gave way to depressed prices in the whole of the period of the 1980s and 1990s, with spot prices below the cost of production for all but the lowest cost mines. Spot prices recovered from 2003 to 2009, but have been weak since then. Of course, there was also a lot of financial speculation in the markets in 2007, with the last high of $140 per pound. The quoted spot prices through to about 2007 applied only to day-to-day marginal trading and represented a small portion of supply. Since 2008, the proportion has approximately doubled to about 1/4 in the last decade. Most trade is done through 3 to 15-year term contracts, with producers selling directly to utilities at a higher price than the spot market, reflecting the security of supply. The specified price in these contracts is, however, often related to the spot price at the time of delivery, and also contracts can have floors and high cap prices. In 2000, primary market participants, utilities and producers, accounted for 95% of the spot market. That share decreased to 2/3 of 2005 and 1/3 by 2011, and it has remained at 30 to 40% since. The rest comes from the financial community, namely traders, financiers, and new ETFs and financial instruments like uranium managed accounts, who have moved in and on the market, bringing greater liquidity and efficiency. The reasons for fluctuation in mineral prices relate to demand and perceptions of scarcity. The price cannot indefinitely stay below the cost of production. We see since several years now a growing deficit in the uranium market, which will not diminish. We expect the deficit to stay for at least 7 to 10 years, as there are not enough new large mines coming into production to erase the deficit. Also, demand grows constantly, and we do not yet know the situation around the SMRs from 2028 onwards. About 440 reactors with combined capacity of about 390 gigawatts require some 80,000 tons of uranium oxide concentrate containing about 67,500 tons of uranium from mines each year. This includes initial cores for new reactors coming online. The capacity is growing slowly, and at the same time, the reactors are being run more productively, with higher capacity factors and reactor power levels. However, these factors increasing fuel demand are offset by a trend for increased efficiencies, so demand is dampened. Over the 20 years from 1970, there was a 25% reduction in uranium demand per kilowatt-hour output in Europe due to such improvements, which continue today. Each gigawatt of increased new capacity will require about 150 tons uranium per year of extra mine production routinely and about 300 to 450 tons uranium for the first fuel load. The fuel burn-up is measured in units such as megawatt days per ton uranium. Increases in burn-up reduce the number of fresh fuel assemblies which need to be loaded. Higher burn-ups therefore result in potential cost savings for the utility at both ends of the fuel cycle. However, increases in burn-ups sometimes, but not always, require increased enrichment levels in the fuel assemblies, which increases the uranium and/or the enrichment needed for each assembly, thus increasing the cost of each assembly. During 1980 and 2010, burn-up levels increased, compared with original design, to around 40 megawatt per day ton uranium for most light water reactors, with reductions in specific uranium consumption. Some utilities have continued to increase burn-ups further, and levels of 45 to 50 gigawatt per day per ton uranium are now common. However, increasing burn-up above the 40 gigawatt per day ton uranium only reduces specific uranium consumption slightly, while very slightly increasing specific enrichment requirements. For example, an increase from 40 to 50 gigawatts a day per ton uranium reduces uranium requirements by 4 to 5% and increases enrichment requirements by about 2 to 3%. Generally, utilities have pursued higher enrichment and burn-ups, and when uranium prices were high, they specified low-tails assays from enrichment to get more fuel from it, so that significantly less natural uranium feed was required. However, more enrichment energy was then needed. There is a clear trade-off between energy input to enrichment and uranium input. Because of the cost structure of nuclear power generation, with high capital and low fuel costs, the demand of uranium fuel is much more predictable than with probably any other mineral commodity. Once reactors are built, it is very cost-effective to keep them running at high capacity and for utilities to make any adjustments to load trends by cutting back on fossil fuel use. Demand forecasts for uranium thus depend largely on installed and operable capacity regardless of economic fluctuations. However, this picture is complicated by policies which give preferential grid access to subsidized wind and solar PV sources. We think nuclear and renewables are a perfect match in a world seeking for zero emission in power generation. The market grows well further in the next 10 to 20 years. The reference scenario of the 2023 edition of the World Nuclear Association's Nuclear Fuel Report shows a 28% increase in uranium demand over 2023 to 2030 for an 18% increase in reactor capacity. Many new cores will be required. Demand thereafter will depend on new plants being built and the rate at which older plants are retired. The reference scenario of the 2023 Nuclear Fuel Report has a 51% increase in uranium demand for the decade of 2031 to 2040. Licensing of plant lifetime extensions and the economic attractiveness of continued operation of older reactors are critical factors in the medium-term uranium market. However, with electricity demand by 2040 potentially increasing by about 50% from that of 2022, based on the IEA Agency's World Energy Outlook 2023 report, there is plenty of scope for growth in nuclear capacity in a world concerned with limiting carbon emissions. We already saw in the USA a lot more prolongations of operating permits for nuclear power plants, extending the life of operation to 60 plus years. The mine supply is very inelastic these days. Mines in 2022 supplied some 58,201 tons of uranium oxide concentrate, U3O8, containing 49,355 tons uranium, 74% of the utilities' annual requirements. The balance is made up from secondary sources, including stockpiled uranium held by utilities, and in the last few years of low prices, those civil stockpiles have been built up again following their depletion over 1990 to 2005. At the end of 2022, there were estimated, and those are estimates only, at about 36,000 tons uranium in Europe, 40,000 tons uranium in the US, about 132,000 tons uranium in China, and about 49,000 tons uranium in the rest of Asia. Also to notice that at the prices which utilities are likely to be paying for current delivery, only 1/3 of the cost of the fuel loaded into a nuclear reactor is the actual ex-mine or other supply. The balance is mostly the cost of enrichment and fuel fabrication, with a small element for uranium conversion. With the main growth in uranium demand being in Russia and China, it is noteworthy that the vertically integrated sovereign nuclear industries in these countries, and potentially India, have sought equity in uranium mines abroad, bypassing the market to some extent. Strategic investments in uranium production, even if it's not lowest cost, has become the priority while world prices have been generally low. Russia's ARMZ bought Canada-based Uranium One in 2013, and China holds equity in mines in Niger, Namibia, Kazakhstan, Uzbekistan, and Canada. But from where you can get supply elsewhere? As well as existing and likely new mines, nuclear fuel supply may be from secondary sources, including recycled uranium and plutonium from used fuel as mixed oxide, called MOX fuel, re-enriched depleted uranium tails, ex-military weapons-grade uranium, blended down in civil stockpiles, and ex-military weapons-grade plutonium as MOX fuel. Commercial reprocessing plants are operating in France and Russia with a combined capacity of about 2,000 tons of heavy metal, THM, per year. World reprocessing capacity would increase by 800 THM with the restart of the Japanese plant of Wakashomura. Further capacity is under construction in Russia and China, and there are a number of other plants with small reprocessing capacities worldwide. We think that despite those sources, the deficit is still there and growing, which could lead soon to a much higher price level. If you look what the graph shows, if you have a look at the graph, this shows you how these various sources of supply might look in the decades ahead. The graph shows a breakdown of the reference scenario of the 2023 edition of World Nuclear Association's Nuclear Fuel Report into current mine capacity with idle capacity separated and capacity that is under development, planned or prospective. The black line shows the reference scenario of the 2021 edition of the Nuclear Fuel Report for comparison. To meet the reference scenario requirements from early in the next decade, in addition to restarted idle mines, mines under development, planned mines, and prospective mines, other new projects will need to be brought into production. Considerable exploration, innovative techniques, and timely investment would be required to turn these resources into refined uranium ready for nuclear fuel production within this time frame. We need everything we can get to power all those new reactors, existing ones, and also the coming tsunami of SMRs. Now is the time to get into the good uranium companies. Let's start with Uranium Energy Corporation. The company is one of the largest resource holders in the world, has restarted their production in the US, are unhedged, and have $350 million in cash and liquid assets like 2 million pounds of physical uranium. 65 nuclear reactors are under construction and 430 are planned and proposed. They need all fuel, ladies and gentlemen. UEC is ready to supply the US from the USA inside. They have 4 production growth pillars they stand on. This is Irigaray Central Processing Plant, the Hobson Central Processing Plant, as well as the Sweetwater Central Processing Plant and the Rough Rider Conventional Asset. With the first 3 plants, we see a possible combined annual production of 12 million pounds within the next 3 to 5 years. Rough Rider is a large project for the next decade with enormous potential. UEC's chart is going very well upwards, and the breakout from the consolidation around the $7 to $8 will immediately open up a price potential of $14 for the share. Longer term, we have an $18.50 price target. The next fantastic uranium company is ISO Energy. They are restarting their Tony M mine and have also more production potential with their Rim mine, Sage Plain, and Dannerous mines in the USA. In Virginia, they own the Coles Hill project, which hosts a large resource and is ready for future development. The company owns also the Hurricane project with La Roque, the highest grade project in the world and neighbors directly to Cameco and Urano. They are on track to becoming a multi-asset producer with near-term restart potential and milling capacity. In our pointed figure chart, the stock has an immediate price target of $5 Canadian for us. Longer term, we see here $8.5 Canadian as possible. Another great company is Premier American Uranium. The company owns 3 of the uranium districts in the USA, which are the Grants Mineral Belt in New Mexico, the Great Divide Basin in Wyoming, in Colorado, and in Colorado, the Uraban Mineral Belt. In 2024, they did the acquisition of American Future Fuel and commenced trading on the OTCQB marketplace. They updated the mineral resource estimate for Ceboletta and set the stage for expansion drilling and much more. The chart marks a double bottom, which opens up a favorable entry opportunity. We have set an initial price target of $3 Canadian 20. Another interesting exploration company is Cosa Resources. They have a great collaboration with Denison Mines. COSA acquired a majority interest in 3 highly prospective uranium projects in the Athabasca Basin, and Denison Mines is now COSA's largest strategic shareholder. COSA owns 500,000 acres in the Athabasca Basin, and the projects are ideally situated. The chart looks good, and we think the stock generates here a buy signal with a first price target of 60 Canadian cents. Last but not least, there is only one royalty company in the uranium space: Uranium Royalty. Great company without a mining risk, highly liquid, and holding physical uranium. The company has a strong balance sheet, which positions it to capitalize on accretive uranium royalty and streaming acquisition opportunities. The portfolio includes interests on 21 exploration, development, advanced, permitted, and producing uranium projects in multiple jurisdictions, including royalties on the world-class McArthur River and Cigar Lake mines. The point figure chart has built a nice bottom and will turn soon to the upward. The price target is 8.5 Canadian dollars for the stock from the buying signal from February 2024. Uranium is ready to go and to move massively higher. Solid uranium companies will perform nicely, like the ones mentioned. Nuclear power is set to reach a new record in 2025 and can improve energy security as electricity demand accelerates, although costs, project overruns, and financing must be addressed, according to a new International Energy Agency report. The 98-page report, The Path to a New Era for Nuclear Energy, says renewed momentum behind nuclear energy has the potential to open a new era for the secure and clean power source as demand for electricity grows strongly around the world. IEA Executive Director Fatih Birol noted in his foreword to the report that 4 years ago, IEA had said that nuclear energy was well positioned to make a comeback after a difficult period following the 2011 accident at Fukushima. Today, this comeback is clearly underway, and nuclear now stands on the cusp of a new area owing to a combination of government policies, technological innovation, and private sector interest. At the same time, several major challenges still need to be overcome on the path to this new era. He said, innovation is changing the nuclear technology landscape through the development of small modular reactors, the SMRs, the first of which are expected to start commercial operations around 2030. We think also by 2028 is also possible. Alongside renewable technologies such as solar and wind, whose electricity output is expanding rapidly, nuclear can play an important role in meeting growing power demand securely and sustainably. That's what he says. We think so too, that the combination of the renewable and the nuclear world will lead to carbon-free energy world. A key role will also play the SMRs. The IEA report is optimistic about SMRs. Cost-competitive SMRs boosted by government support and new business models can help clear the path to a new era for nuclear energy. Demand for firm, dispatchable, and clean power from the private sector is a major driver of interest in these emerging technologies, and there are plans of varying maturity for up to 25 gigawatts of SMR capacity, in large part to meet growing electricity demand for data centers, they said. And the report added, under today's policy settings, total SMR capacity reaches 40 gigawatt by 2050. But the potential is far greater. In a scenario in which tailored policy support for nuclear and streamlined regulations for SMRs align with robust industry delivery on new projects and designs, SMR capacity is 3 times higher by mid-century, reaching 120 gigawatt, with more than 1,000 SMRs in operation by then. This rapid growth scenario would raise investment in SMRs from less than $5 billion today to $25 billion by the end of this decade, with cumulative investment of $670 billion by 2050. IEA believes the rise of SMRs alongside a new wave of large-scale reactors built on time and on budget can open the possibility for Europe, the USA, and Japan to reclaim technology leadership. According to IEA, SMRs can dramatically cut the overall investment costs of individual projects to levels similar to those of large renewable energy projects such as offshore wind and large hydro. This makes SMRs less risky for commercial lenders once first-of-a-kind projects are established and technologies are proven. The more modular design of SMRs significantly cuts construction times, with projects expected to reach cash flow break-even up to 10 years earlier than for large reactors. The strong credit rating of the technology players behind data centers can also facilitate financing for SMR projects targeting this sector. We are bullish for uranium and the whole sector. Time is now to build positions in good uranium stocks. You find all the information also on our Commodity TV app in German and English, plus all about commodities. Please note the disclaimer. The shares discussed are part of the SRC Mining Special Situation Certificate, and I'm a shareholder, of course, in the companies. Thanks for watching us, and bye-bye from Switzerland.